The US Federal Reserve will be announcing its policy decision later tonight, and while the markets are pricing in about a 25 basis point rate cut, the path does not seem to be as easy for Jerome Powell, with key members of the FOMC dissenting against any such rate move. Let's discuss the expectations from the Fed with Daryl Liew of REYL Singapore. Daryl, thanks for joining in. Let's start by talking about your expectations and how do you expect this perceived drama to unfold today at the FOMC?
Well, I think basically everybody's expecting at least a 25 basis point cut right now. But when you look at the broader economy in the US, the economic numbers actually are still relatively strong. You look at the jobs market, for example, unemployment rate at just 3.7%. I think the city economic surprise index is also rebounded to a significantly high level. So actually, if you look at it purely on the economic merits, there's actually no real need for the Fed to be cutting rates, which is why I can see why there are people within the Fed that's dissenting towards a rate cut. However, if you look at the broader economy, the global economy that is, with the US-China trade wars, deceleration in a number of other economies, it does look like actually the Fed is possibly trying to bail out the global economy. And actually, if you look at it, we've looked at an analogy with 1998, actually. That's when the Asian financial crisis was hitting many parts of Asia. The US economy back in 98 was actually relatively strong, but the Fed actually proceeded to cut rates by 3 times to help out the broader economy, because when you have rate cuts in the US, it actually eases pressure on a number of the Asian central banks, for example. So that possibly could be one of the reasons why Chairman Powell is actually looking at a possible rate cut.
Hi Daryl, good afternoon to you from India. 25 bips is something which the economists are already factoring in for today's announcement. But if that comes about, do you expect more rate cuts going ahead for this calendar year from the Fed chair?
Yeah, that's the challenge there, because I think if you look at what the market's pricing in is looking at something like 1% cuts or 4 cuts in the next 12 months. That to me seems rather excessive, because as I said before, the economic numbers in the US actually doesn't really justify having a need to cut at this point in time. So I think after the Fed moves likely today by 25 basis points, there could be possibility of another cut by year end. But I don't see the real need for any further cuts unless the global economy shows further sign of weakness. Meaning to say, if we don't get a resolution on the US-China trade side, if, for example, oil prices stay stubbornly high, you see a continued deceleration in the economic numbers coming out from the rest of the world, as well as a slowdown in the US, then possibly we could see a couple more rate cuts in the next several months.
Okay. Daryl, in that case, what is your near-term view on how you expect fund flows to come through to emerging markets as compared to what the situation is in the developed markets?
Yeah, that's a good question. I think emerging markets have been under a bit of pressure in the last several months. And I think one of the reasons for that is that a number of emerging markets have been under a lot of earnings pressure. So if you look at the quarterly earnings numbers coming out from a number of markets here in our region, it's been under a lot of pressure. They've been continually revised downwards. But at least what I've seen from the latest weekly numbers, it appears that that's troughing out. So I think one of the key signs that we are looking out for is whether or not earnings expectations can trough out, and whether we can see a rebound in that regard. Because otherwise, what we've seen is actually the PE expand here despite the relatively weak numbers, simply because the earnings numbers have been revised downwards. So I think that would be a key sign as to whether or not we'll see fund flows coming back to the emerging markets.
Daryl, just a last question from my side. Within the emerging market basket, we've seen India underperforming if you were to compare the returns of MSCI India to about MSCI emerging market? And FI participation, I think the selling remains unabated for the last 3 months, especially after the union budget, which was declared in India. Post that, they've been selling incessantly. Any thoughts on India? Any feedback that you get when you interact with investors, whether the current economic slowdown, which has come out as a key reason why we've seen the correction also in a couple of, the industry, for example, the auto space in India has been reeling under pressure for the last many months. So what's the outlook here within the emerging market basket? Where does India stand?
Yeah, that's a good question again. I think really the GDP number probably took a number of investors by surprise, which is possibly one of the reasons why the selling has been occurring. But in addition to that, I mean, my main issue is because we do invest in India and we do look at Indian markets as well. My main issue of the Indian markets, again, going back to corporate earnings, it's been disappointing to a certain extent over the last several years, because I think when you look at analyst expectations, the Indian market probably has a lot of potential to grow earnings in the mid-teens actually. But that's failed to materialize over the last couple of years. Having said that, if you look at India compared to the rest of the broader Asia and emerging markets, it's actually one of the markets where you do get a bit of earnings growth. A number of other markets, for example, the Korean market, for example, has been hammered because it's been seeing very, very big downward revisions simply because it's very tied into the global supply chains and it's being hit by the trade wars. So India, in that side, is probably the best of a bad bunch. But having said that, I think we do need to see an improvement in earnings growth coming out from India before probably international investors come back in again.
Daryl, so again, my question really is to do with comparatively, what are the markets that you are looking at which at this point in time have offered or are offering better prospects in terms of returns as compared to the Indian markets?
Well, we look at it on a risk-reward basis. And obviously because of the trade side, a number of the North Asian markets, for example, have been hit a lot harder. So countries like Korea, for example, the Hang Seng has been one of the key underperformers simply because of the demonstrations out there. So actually, when you look at it from a bottom-picking perspective, some of the Northern Asian markets might look a bit more attractive in terms of entry points from that regard, that we see a potential rebound if we do get some resolution on the trade front, for example, or if the Hong Kong situation gets resolved. So I think when you look at it from that perspective, maybe those markets are looking a bit more interesting vis-a-vis the Indian market.
All right, Daryl, we leave it at that note. Appreciate you joining us today and taking us through your views on the world equities as well as India.